From my perspective, real estate is the best vehicle through which to leave the corporate world, because the likelihood that you're going to succeed is much higher than real estate than it is in all other entrepreneurial endeavors. There's just much less unknowns when it comes to the sector. So many advantages that are specific to real estate, which is why it's a great way to make the leap. However, making a leap isn't that easy at all. And once you do, there's a million ways you can go wrong. And that's what we're going to talk about today with a guest who was very well positioned in the corporate world, but decided it wasn't for her. But it wasn't just roses and lollipops ever since then. She certainly made some missteps along the way, and she's not afraid to share them with you so you can learn from her mistakes. So in this discussion, we're going to talk about what operators in the real estate sector are doing incorrectly. That kind of gives her pause. We're going to talk about some questions, some due diligence questions that you can ask a potential property manager when researching new firms that you may entrust your hard-earned investment capital and your investors' investment capital with. We're going to talk about our guest's capital raising system, which really is a system. And, of course, mistakes that our guest made in their career and the lessons learned from them. Also, Intelligent Investors Real Estate Conference in 2020. It is going down. Important announcement. Right now, for the first time, you can actually purchase single-day tickets. So we opened that up. There's only about 1 week left before the conference actually takes place. So if you're interested, if you're in LA, maybe you're only there for one day or only want to make it a weekend thing, but you don't want to go to the real estate conference for both days, there are single tickets available now at the website, intelligentinvestors2020.com. And yes, the $100 discount code, if you put in ASYM, it'll give you $100 off even on the single day tickets. Now, of course, it's more expensive to get 2 single day tickets than to get the entire weekend, but you probably assume that. Anyway, so if you haven't already gotten your tickets, go to intelligentinvestors2020.com. I will see you there along with some of the most amazing speakers, industry leaders, thought leaders, economists, authors, amazing people in the business, people that I love to work with. I will see you there January 25th through 26th in Los Angeles. How's it going, everyone? Our guest for today is Ellie Perlman, who is the founder and CEO of Blue Lake Capital, which is a real estate investing firm which specializes in multifamily investments. Ellie holds a master's in law and an MBA from MIT, and she started her career as a commercial real estate lawyer, then transitioned to property management, oversaw properties worth more than $100 million, and she's the host of a podcast called Ready to Scale, and that's available at ellieperlman.com. We'll link to all that in the show notes page. Before we jump into it today, Ellie, thanks so much for coming on.
Hi, Hunter. How are you? I'm really happy to be here today.
Yeah, as well. You know, I've seen your business growing over the last couple of years. I've seen your podcast continue to grow and develop, and I'm really looking forward to this conversation, especially as it relates to kind of adding value to multifamily properties, raising capital, and things like that. So for the listeners that aren't familiar with you, let's start with kind of your background. You know, how did you get into this? You know, what, most importantly, I'm interested in what drew you to the MBA track? And then obviously the position you're now is not a typical MBA track, despite getting that awesome academic background. What was kind of the background that led you to that? And then when you realized, you know, I want to go a different, more entrepreneurial route.
Sure. So I've always been in real estate because that's what I've loved doing. So I was a real estate lawyer and a property manager. But at some point I felt that I wanted to learn the business side of real estate. And I felt that that was the thing that was missing in my education. I didn't know quite at that point that I wanted to become an investor. I thought, you know, I needed to be a millionaire or have a lot of money to buy real estate. And I told myself I would build myself, you know, I would work for another company and save money. And then when I'm going to have enough money, then I'm going to start buying properties. But that's, you know, basically that line of thinking of, hey, I need to know more about the business side of things is what drew me to pursue an MBA. And you know, I'm a huge believer in diversifying your education and expanding your mindset, because now when I'm looking at a deal, a project at my company, I don't only see real estate. I see real estate, of course, but I see the legality of things. I see the business aspects of things in terms of, you know, the best way to market a business, the best way to position my business. And so that really, you know, the different type, you know, my unconventional, I think, background really positioned me to achieve to achieve success in real estate and see things a bit differently. But you're right. It's not what I do now. I think I'm the only person from my class that graduated from MIT that is not hasn't started a startup or went to work for Facebook, Instagram, well, actually kind of the same, but Facebook, Amazon, all those big companies. And I know I'm pretty unique in that sense, but I only do what I love. And it's exactly where I am now.
Yeah, I totally hear you on that, and I'm definitely sympathetic to that. Just before we even jump into it, what is it about real estate that kind of enticed you to take this on as a business owner, as opposed to, that other route that you're talking about, either, doing some consulting gigs or working for a startup, et cetera?
Well, I think some of it is, so I can answer that in two ways. One of it is the emotional kind of path that led me there. When I was struggling in my teens and beyond that financially, I knew a guy that lived in the States. He was an Israeli guy, and he started a real estate company, and he was buying multifamily properties. And so that kind of put the emphasis on multifamily and real estate in general, because I knew that the people that were around me that were very successful were actually investing in real estate. And that's the emotional part of it. The other part is the rational part, which, I understand that with real estate, you can actually scale. You can enjoy economies of scale, especially with multifamily, with large apartment buildings. It's sustainable. I can see it. It takes a really extreme situation to lose your investment, even in a recession, if you invest right. So all those things actually drew me to real estate, and specifically multifamily. And I know recession is coming. We don't know when and how severe it's going to be. But I want to point out that the default rate with investors who took a loan from an agency, took an agency debt, Freddie, Fannie, was less than 0.5%. So I think, definitely some people lost money there. But for me, I feel more secure that I'm buying the right type of asset, especially where we are in the cycle right now.
Yeah, and that's actually like a record play stop type of data point that you looked up. And I did hear you talk about this recently, and I haven't actually cross-referenced it, but let's assume it's 100% accurate. That is insane. So just to restate what you just said, the default rate for agency debt, and I believe it's above 100 units or more, I could be wrong about that, let me know, was less than or right around 0.5%, even during the most significant real estate correction in the history of the United States.
That's right.
That is a very telling data point, and it's something that is completely missing from the conversation because there was absolute devastation in the single family space. We saw a 30% price correction, but if you're owning units and you own a lot of them and you have enough cash flow to pay off your debt service, the fact that your valuation may be down by 30% is completely inconsequential. If you're able to continue to service your debt, you can hold through that downturn. And so I do need to reference that, but I'm just, it's within reason given what I've heard in the industry, but I haven't looked it up. That's amazing and is just such an important telling point. It's some points where, and I actually mentioned this before on your show, which is that if you owe someone, it depends on who you owe, right? But if you owe a bank $2 million, you got a problem. If you owe a bank $30 million, you got a friend. It depends on the bank, of course. But it's one of those things where if you increase that dollar amount, you're playing in a different world. And that can really impact the way those negotiations go, even if you do have problems.
Absolutely.
So point well taken. So let's talk about, your first deal, like the first deal where you saw an opportunity, you went all in, either you raised money or you were as an investor. How did you get involved on that side of the business?
Sure. So the first deal, and it's funny because I was just on another podcast just telling that story. So I'm happy to tell it again. The first deal that I've done was a deal that the property management company that I was working with basically, recommended that I pursue this deal, which was a little bit bigger than what I thought I would go for. And I had a mentor at that point that I was consulting with, and we made it to the best and final. So, every time you have a deal, you submit an offer, there's a call for offer date. And then about a week later, you have a call with the seller. And then the seller decides, the seller chooses the winner. And that is basically the best and final round. And I was able to get into the best and final with 4 other groups. So I called my mentor and I said, hey, I got into the best and final in this deal called X, and it's a great deal. I love the market. And there was a silence for a second there, a silence on the phone. And my mentor said, well, we're in a best and final for this deal as well.
Oh, wow.
And so I found out that we were both competing for the same deal. And so we couldn't talk about this deal anymore. We talked about other things, but not about this deal. And the seller ended up, it took him about 2 or 3 days to decide who to go with. And the broker told me, it's you and another group. And I said, I know who the other group is probably. I know who they are. And he was contemplating between the two of us. And he chose to go with the other group. And I know that because A, I didn't get the deal, but also I got a phone call from my mentor saying, so we got the deal. Would you like to partner with me? And my ego is a little bit bruised because, I was going after this deal hard, and I really wanted to get the deal. And at the end, I found a way back into the deal. I put my emotions aside, and I didn't let my ego dictate what I'm going to do. And I'm really happy I did, because it turned out to be a great deal.
Yeah, that's a great story. And for a lot of reasons, I think the thing that you're talking about that people don't contemplate is the ego part. Like, objectively, I think it would make sense. Okay, yeah, sure, I'll partner with my mentor and this will all be great. Plus, I'll get to learn something from them along the way. But that's something that a lot of people aren't prepared for, is that emotional component. When you do get that email saying, after all that work, if you may have even flown to see the property, you may have even flown to see the owner and pitch them on why you should be the buyer. After all that, the total result's going to be net zero because someone that's more experienced than you got the deal. And it's like, man, I am absolutely crushed. And I've certainly been there, funds falling apart at the last minute, things don't work. And it's like, damn, it's so emotional. But then at the same time, if you're able to see through that and realize what's at stake, what do you have to gain? Can this be a beginning of a really great story? The story that later you'll tell on a podcast such as this when it's talking about your first deal. You can see that opportunity. So yeah, I appreciate you sharing it with us, especially the emotional component. So let's kind of fast forward to today. What does your current investment thesis look like? Where are you currently investing? Where are you seeing it being advantageous to deploy capital?
So I mainly invest in Texas, Florida, and Georgia. And I chose those markets after a month of research. I literally took a month to research the markets. And so the reason why I chose those markets is because they have a significant rent growth, a significant population growth. So people are migrating to those markets, and you have job growth. And I think that all those three growth factors are, related to one another, because once you have a state that is good to employers, have more and more jobs. Those jobs bring people from out of state, and you have higher demand, and this demand is what's responsible for the increase in rents. I also like to be in states that are landlord friendly. So, I live in California right now, which is a great place to live in Santa Monica. But, if I owned anything here, forget about the price or the cap rates, for instance, it would take me 10 to 12 months to evict someone who doesn't pay. And so they're very, very, and of course I'm not going to even start talking about the rent control that we have here that is absolutely terrible for investors. And so the ability to raise rents after you improve, units, or even if you decide not to improve the units, because, if you bought a property that has rents that are under market, the ability to push rents, the ability to push tenants out if you want to bring new tenants, or if they, trash your apartment, ruin the apartment, or just stop paying rent. All these things are, it's going to be very hard to manage a building and have a successful investment. And so that's why I like to stay in Texas, Florida, and Georgia, where you have all those benefits. You have a tremendous growth, but you also have other regulations that are really benefiting owners.
Certainly. I mean, the markets you're mentioning obviously come up a lot in these conversations. And really the key is looking at those markets, that there's tailwinds there. I mean, part of this podcast is a great way for me to do data analytics and research. So I talk to people that are succeeding in real estate, and you hear the same things come up over and over again. Then you need to dive in and look at your own data. We had Neil Bawa on the program recently talking about market dynamics, and you can figure this stuff out. It's so funny because you mentioned that you took a month and came to this conclusion. It's amazing with the amount of data that's out there. You can have a fully rational and objective data-driven thesis if you spend a month focusing exclusively on market dynamics. And these things don't change rapidly, right? It's like, that's one of the benefits of real estate. It moves like a barge rather than the stock market, which is up and down and crazy. Like,
Right.
Atlanta, Georgia, for example, is going to be the benefactor of a massive tailwinds for years to come. That's just the way it is.
Mm-hmm.
So anyway, thanks for sharing that. Your background is really, part of your background at least, is in the management asset of the properties. So first of all, what are you doing currently to manage these assets super far away all over the country functionally, and then also from a strategy perspective? So do you have third-party management, and how do you select that management, for example?
Sure. So yeah, we do have a third party management company. Even if I lived in Atlanta where, we own assets, I would not try and self-manage unless I would buy a property management company or establish a property management arm as part of Blue Lake. I'm not going to try and attempt and do that. And I've seen other owners trying to save money by self-managing the assets, and they just did a terrible job. Their assets were not in a good shape. The rents were under market. Their team was not as good. So yeah, we do hire third-party companies. That's what they do best. They know how to manage assets, how to manage the renovations, how to bring tenants in. That's what they do best. And this way I have time to do what I do best, which is finding deals and raising money. And I manage the asset, which is different than manage the property. So we have a property management company. They hire the leasing officers, the maintenance team, and they have their own supervisors that manage the asset. And then we basically manage them. So being remote, it's a little bit challenging. I can tell you I'm flying very often, probably once every 2 to 3 weeks. And I go visit the properties, but these guys are there every day. So we do have some KPIs, and, we look at the numbers very closely and we manage them from far, but we also fly out there and see the asset, every few months or so.
Give us an example of some of the things that you can keep an eye on where, like the KPIs you mentioned, like what are some of the key metrics that you're looking at to say, okay, look, this property is clearly in line with our expectations. This property needs a little bit more attention.
Sure. So one of the things we're looking at is in terms of the income and expenses, we're comparing the projections versus the actuals. So I want to know, some variance is okay, but if we are 20% higher, 20% higher on income compared to what we've predicted is excellent. When it comes to expenses, that's not the case. So understanding what's happening, how can we, prevent it from happening moving forward, and get some answers, for the reasons. And so that's part of the KPIs. Others are the occupancy level, the number of units that have been renovated every month. For instance, what are the metrics, what are the numbers for delinquency if we have some bad debt in the property, meaning debt that, rents we couldn't charge from tenants for all kinds of reasons. What is that number? How is it trending? These are just some of the key KPIs we're looking at.
Yeah. Thanks for sharing that. A lot of people may be thinking, okay, it'd be nice to be able to buy a property in Atlanta, but there's plenty of property management companies out there. It's very challenging. Everyone's website looks the same. What are some of the ways that you can really get to the bottom of it? What are some of the questions you can ask to vet a property management company to find out who's going to be in that best of class and who is going to be just someone that has a website?
Go see their properties. Go see the properties they manage. I can tell you that many companies are very impressive over the phone or where you visit them at their corporate office. Ask them to take you and show you some of the properties they manage, and then go to other properties without them knowing that you're going there. That's what I did.
100%.
You can pretend to be a tenant and see how the property looks like. Is it clean? What's the quality of the staff? I actually hired the property management company that I'm working with after seeing their property in 2 other property tours that I was doing for 2 other properties that I wanted to purchase. And I was so impressed with how the property looked like and how happy the tenants were that I reached out and had a conversation with them and eventually hired them. You can also ask the local brokers for referrals. And if you hear the same name over and over again, then it's a company you should be talking with.
Yeah, I agree. And, this has been a theme throughout my career, especially late in the cycle. I just want to reduce the amount of unknowns as much as possible. And so I'm willing to pay to play with the most experienced teams, sometimes the largest teams in the market. Usually you'll find, okay, here's the 3 major players, and that's going to be what I'm going to be dealing with, right? I'm not going to be dealing with the mom and pops that are looking to get started. They want to have their second deal. No.
Exactly.
I want to have the people that have the systems, the processes, the software, the data, et cetera, that we can already leverage those for our property. And so I think that that's, when you have those 3 in front of you, it makes your job a lot easier. And I love going and visiting. I had to recalibrate the way that I was thinking about property management, coming from someone who was really focused on the mobile home park business almost exclusively for years, and then going into multifamily. In mobile home park business, property management isn't really a true job. It's the kind of job that someone who's maybe retired can do. It's a part-time job at best. You don't really do too much. There's just not that many complications of it. With multifamily apartments, you need someone who is a top-tier, detail-oriented go-getter, because they're going to get an income level, which is like a legitimate income level. And so when I started visiting properties, when I started looking at multifamily again, at first I was like, wow, these guys are great. And then I started to, okay, I see. This is like a completely different caliber person. This is like they just have to have everything, and the sales and the smile and the approachability, big factors when it comes to actually getting units leased.
Yeah, absolutely. You need an entire team, and they have to be professional. The company that I've hired, they manage over 40,000 units across the US. So they have experience. But another piece of advice is the company is as good as the VP that is managing your assets. So you're going to be working with a specific person at each market. So if you don't get along with that person, or if you don't like them, then the company can be great. But at the end of the day, you're working with one person. So just make sure that you're good with that one person, that you like them, that you like their experience, that they, make sure that they can do what you want them to do.
Right.
Which is not a given.
Yeah, for sure. So let's talk about kind of the financial side of things, because I know that this is obviously something that interests you as well. So in terms of underwriting, what are kind of the profile of deals that you're currently seeing? I'm like, just getting into the numbers. Let's talk about, the rehab per door. What does the typical rehab incur in terms of like the return on costs? Like, what do the numbers look like on your end?
Sure. So usually we would do anything between $2,500 per door to $7,500 per door. And obviously, the nicer the property, the better the area, the higher dollar amount we'll be willing to put in. The average is around $5,000. In terms of return on investment, we're talking about 35 to 50% return, which, basically means if we're going to put $5,000 to improve, if you're going to spend $5,000 to improve the specific unit, we're probably going to get $175 as a premium, which is basically, the addition we're going to charge based on the classic unit that is not renovated. That's only one part of it, but I don't focus too much on the ROI, because we have to also remember on the back end, once we sell the property, the higher the NOI, the higher the price we can get for the property. So even if, the ROI in terms of the dollar amount I'm putting in right now and the dollar amount I'm getting back from premiums, it's short-sighted. It's an important metric, but it's not as important as how much these rent bumps are helping to improve the increased NOI, which in turns that's basically how you also make about 40 to 50% of the returns in your total investment on the back end.
Right.
Just remember that. Then don't focus overly on the ROI, because the back end is also very important.
Yeah, and I'm just going to restate that for those that may have not got it, because I completely agree, and it's actually an important metric. So in a typical value add, slightly stabilized value add type of multifamily, or any asset where there's people that are paying, let's say it's 85% occupied or more, when you're looking at a deal like this, the total return should typically be about 50% should be provided through cash flow, and about 50% should be provided through gains from the sale. And if you start to tip those scales on either side of that, then you're starting to get into very, very stabilized or very, very value add heavy. So another example would be as a development, to make an extreme example, if you have zero cash flow for the first 3 years and all of a sudden you get $5 million, then that would be like 100% of the proceeds are attributed to the sale, as opposed to the other deal where if you're like 99% occupied and it's really a high cash flow play and you sell the property for close to what you bought it for because there's not a lot of value add potential, then a more significant amount of that would be attributed to cash flow. So just wanted to restate that. So just diving further into numbers, and let's start with like a big picture. I know we already jumped into return on cost, et cetera, but what is like the unit size that you're getting for these properties? Like how many units would you typically be interested in?
So usually 100 is on the lower end. I think 200 is kind of our sweet spot. But usually I would look at anything that is 100 to 500 units.
And when you go into increased value, talk us through how you actually go through that process. Like renovating the doors, do you do them all at once? Do you cycle them out? How does that work on your end?
Very good question. And I'm actually often asked by investors, do you evict everyone and then renovate the units and then find new tenants? The answer is no. So the first thing I do is I start with the vacant units. Let's say there's a 100-unit building and 5 of them are vacant. So I'm going to start renovating those vacant units. And then each unit that is becoming available when a tenant just does not renew their lease, we're going to get in the moment they leave. We're going to get in, it takes on average about 10 to 14 days to complete the renovation. And while we do that, the leasing officer is already, promoting that unit and trying to get tenants. So sometimes while we're renovating the unit, we already have a tenant that is supposed to, already signing the lease. But we do it on the units on turn. So, we're pretty conservative. I don't want to artificially increase the vacancy just to renovate. It's kind of an opportunistic renovation plan. Once we have something available, we get in, we renovate, we get out.
Okay. And like, just as an idea, what does the cap rate look like on these types of deals?
Normally, I would say, I think my average cap rate was 5.5.
Okay.
But I bought 2 properties recently. They were above 6% because they were off market. But usually it's between 5 and 5.5.
Okay, got it. And so you're buying the 5.5 or so, implementing the value add strategy, increasing the cap rate, increasing the cash flow, really focusing on NOI growth to generate at least half that return. I really like that. So we have seen a radical popularization, at least in some circles, a popularization of the syndicated world. Now, we're in a little bit of a bubble, and I'm actually a huge fan of bubbles. I'm a huge fan, in terms of echo chambers, right? Like we live in an echo chamber, which is totally cool with me. And I have a lot of reasons. I'll probably do a podcast on a specific topic. I'm a fan of echo chambers. So my point is, sometimes it can feel like we're in a bit of a bubble in terms of the world of syndications. I don't think that's the case. When you look at the global capital markets, there's a massive demand for awesome investment opportunities. There's not a glut of amazing investment opportunities. There's a glut of capital going around looking for yield. But having said that, there have been a lot of new syndicators that have entered the space, and I'm sure you've seen this as well. What do you see that operators that are relatively new are doing that they're doing incorrectly? Like, where do you see a lot of this new talent that are entering the space, making mistakes, maybe mistakes that you made yourself, that they could kind of correct and focus more on more like institutional quality practices?
I see some sponsors renovating the interiors too much. So you don't have to make the units as nice enough that you would want to live in it. You need to wear your investor glasses. And so I've seen in multiple places where the owners threw a lot of money. I saw properties that the operators paid $20,000 per unit, which is a lot of money. There's no return on that money. It's just insane. So I've seen that. I think that's one of the most common mistakes that I've seen. They're renovating the unit too nicely, or even if it's a moderate renovation, it might not be the right one for the population. So even throwing $5,000 or $4,000 per door in C areas, that might not be the right decision, because you're not going to be able to get people to, local tenants to pay you even $150 sometimes. Maybe they can only pay $50 or $75, and then your projections are wrong. So I think that's the number one mistake. Also, I see a lot of sponsors being overly optimistic about the exit cap, about, how quickly they can turn units. And just being very optimistic is not a good thing when you're investing in real estate. I can tell you that.
Right. Let's kind of transition, because I know a lot of your business, at least, is focused on the capital raising side. And I was actually at the Raising Money Summit recently and saw you present there. I know we don't have another 30 minutes left in this interview, but I wanted to give you the opportunity to talk about kind of the big picture perspective about some of the key takeaways of that presentation, but also in terms of raising money, some of the things that are like misconceptions. The way that people think about raising money isn't exactly the way it is. A perfect example of this is, I know that you haven't raised a lot of money from your friends back in Israel. And that would be something that most people would think, okay, like, I grew up here. I know a lot of people here. Why can't I raise money from here? But you kind of recalibrated your network in California and in the online community. I want to talk about that and some of the things you learned while doing that.
Yeah, absolutely. So I don't have even one Israeli investor. So most of my investors are people that I haven't met prior to. Well, that's not true. It's because it depends on the type of the investment. But there were not people that I knew prior to my life as a syndicator. And so social media is such a powerful tool, and you can definitely use that to extend your network. I speak with people from Canada, from Japan, from Alaska, from New York, from all over the place. And it's really, it's really interesting to see that, how you can build your brand and attract investors. And I use my own story. I'm very vulnerable, in terms of, I wrote my entire life story on my website, and people read that so they know who I am. And, I think that's a differentiator, because there's so many syndicators out there. What makes someone choose to work with one syndicator versus another one? We all seem to have similar backgrounds, similar experience. For me, it's my life story, and also the fact that I'm an extremely, extremely conservative, investor, which I think, I attract those type of conservative investor, passive investors as well. But to your point, yeah, you can use social media. And that's what I did. I built my brand by understanding that, hey, well, I like to educate anyways, but I can educate people and I can provide value, and this is key. So I started a blog. I'm writing for Forbes. I've started a podcast, a meetup. In all those, verticals, I basically provide free content. I don't ask for anything in return. I don't do the hard sell. I just share what I know. And that's a great starter for people. It's a conversation starter where people reach out to me and want to talk about, what I wrote, or, a deal that, what they want to do, or where do I invest. And I'm always happy to speak, to talk with people, because I love people. And that's what I love. That's part of why I chose to do real estate. But yeah, just using social media, using the internet to give back first, to educate people, to help share, your knowledge, your experience. This is what ultimately brings investors, to you. And they seek to invest with someone that they trust and someone that they like. And that's, using social media is a great way to do it.
Yeah, it's been a reoccurring theme on the show. It's like, you can make relationship building highly scalable through content creation. And the listeners of this show, of course, know so much about me. I mean, they know more about me when it comes to certain topics than my best friends and family, because we just spent a lot of time together. Now, it happens to be over the internet. It happens to be that a lot of people, thousands of people, maybe even tens of thousands of people, are all listening all together at the same time. But not only does it impact and have the ability to create that relationship with the people that are listening, but the content's there forever. And so I know that you're really focused on productivity, you're really focused on efficiency, but you're able to use this content now for many, many years down the road. You can send them podcasts that you've done years ago, which also helps create that scalable infrastructure.
Yeah, absolutely. You're absolutely right. It's there forever. And you can also recycle and use the content, and share it more than once. And, I have a mentoring program. This is exactly what I teach. I teach how you can use the internet to create content so investors will come to you. So you don't need to chase people down. And it's really not, I'm not a saleswoman. So I really don't feel comfortable going after investors and, going to conferences and trying to meet them and talk to them. I prefer, to put my time, my effort into creating content that can be beneficial for people. And then once they reach out to me, I know they're more likely to invest because they already done their due diligence. They already know who I am. So it makes things a lot easier.
Completely agree. And that is exactly, I am like days away from launching this book. By the time that this podcast is out, the pre-sale will be available. And it's about this exact topic. I'm super passionate about it because there's never been a better time to focus on this. The finance industry moves like very slowly compared to other industries because of all the regulation in it. But there's never been a better time to build your platform, attract investors, nurture them through educational content, and then close deals. So definitely check out your website, tremendous blogs on there. Before you go though, I want to hear an opportunity for you to kind of share with our listeners, a mistake that you made early on in your career and what you learned from that mistake so that someone listening could kind of avoid that.
A mistake that I've made. I'm trying to pick the best one because it was definitely it's not a mistake that I've made. I made multiple mistakes. I think one mistake that I've made was basically assuming that the amount of soft commitments are going to translate into hard commitments, and almost came, short. So basically soft commitment is when you say, yes, I'm interested in a deal. Maybe you sign the PPM, but you don't wire the funds yet. And so I've learned that, if I need to raise, let's say $10 million, I'm basically aiming to raise 25% more. Because there's always people who are going to change their minds, or they need the funds to do other things, or they're traveling, they can't, complete a transaction on time. So I always like to give myself a little bit more of a buffer, because I can tell you if you come short last minute, it's pretty stressful. It's not the most fun thing in the world. So that's why I like to raise more money than I actually need, and naturally things fall into place towards the end. So
is there any kind of ratio you have for that? Like the amount of hard closes? Because by the way, if someone signs our legal documents, like we kind of frame it in such a way that if they sign, they're funding. Right now, I'm not going to pursue them legally or anything like that, but I take it very seriously. But is there any kind of ratio that you get? Like, is it 20% above what you need or somewhere in that range? Or like, what is your thoughts on that?
Yeah, I would say about 25%.
Okay.
25% is what I'm trying to get above the actual target, to allow for, for anything that is going to happen, basically. But no, you're right. Most investors that sign the PPM, they fund.
Okay.
I would say close to 95%, if not more, fund. But there's only also those who say, yes, I'm interested, but never sign the PPM, which, this is where you see more numbers, the higher numbers of
right.
people that actually don't go through the whole process. Yeah.
Yes. And this is part of the conversation, is understanding this, right? And so you can create a system, you can frame it in such a way where you go, hey, just sign the legal documents, no problem. If you need to back out, that's fine. And that could be part of your close system. The key is that you need to clearly identify and systematize your close system and then analyze it based on the results. So if you want to suggest that people sign the docs and in the event that everything works out, it's all good for them to fund, that's one thing. I wouldn't suggest doing that for sure. But you can understand a situation where that might be kind of your inclination. I would suggest saying the soft commitments are no big deal. Block the larger amount. If you think you're going to invest, but may not later, that's no problem. But, make it clear when you're talking to investors. Once you get to a certain point, it's going to be challenging for us. And then once we get past that point, it's going to be impossible. Because technically speaking, the SEC does not allow transfers within the first 12 months of these types of deals.
That's right.
If you invest, you send the $50,000, you technically cannot give them their money back if you countersign those documents. So just be aware of those things.
Yeah, I absolutely agree with you. I mean, once there's a soft commitment, it's okay to back out of it, even though it's not the best thing to do. But once you sign the PPM, we assume that you're going to fund the deal. It's not, sign the PPM, and if you can't do it, that's totally fine.
Right.
It gets tricky because
we're depending on you at that point.
We're saving a spot. Yeah, we're saving a spot for someone. So
Very cool. All right. Well, Ellie, let the listeners know how they can find more about you, your blog. We'll link to all that in the show notes page.
Sure. So you can find me, my website is ellieperlman.com, and Ellie is Ellie. If you also Google Ellie Perlman, you'll see my website and links to my Forbes blog as well. But yeah, I guess that's the best way to reach me. You can also email me at ellie@ellieperlman.com.
Awesome. We will link to all that. Ellie, thanks so much.
Absolutely. Thank you, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.